6 types of retirement plans you should know about. Do not forget to like, share, subscribe and ring the bell for more videos. Each type comes with its own restrictions and benefits. Learning how to plan for retirement doesn't have to feel overwhelming. The various retirement plans available are easier to understand than you might think, although each is subject to its own limitations. Some of these limitations depend on your modified adjusted gross income, while others involve a cap on the amount of money you can contribute yearly. Tax treatment of withdrawals and the age at which you can and must take withdrawals without penalty can vary among types of plans as well. A comparison can help you identify which is best for you. 401k plans. A 401k plan is a workplace retirement account that's offered as an employee savings plan benefit. This account allows you to contribute a portion of your pre-tax paycheck to tax-deferred investments. That reduces the amount of income you must pay taxes on that year. Point 1, for example, if you were to earn $75,000 and contribute $5,000 to your 401k, you'd only be taxed on $70,000. Investment gains grow tax-deferred until you withdraw the money in retirement. If you withdraw funds from the plan before age 59 and a half, however, you could pay a 10% penalty, and the withdrawal would be subject to federal and state income taxes. Point 2, some plans allow 401k loans, however, if you find yourself in a cash emergency. Some employers match their employees' contributions to a 401k, typically up to 6%. However, you might not be fully vested in your plan for a number of years. That means you wouldn't be able to take your employer's contributions with you if you were to leave the company before the prescribed period of time had elapsed. Your own contributions to the plan are always yours, however. If you're not contributing up to the company match, you could be ignoring a significant employee benefit. That match is effectively free money. Employers who offer these plans are often willing to let you make contributions through automatic payroll deductions, which can make saving easier. Point 3. Investment choices for these types of plans are often limited, and management and administrative fees can be high. The IRS imposes contribution limits per year, although limits for 401k plans are more generous than those for other plans. $20,500 in 2022, up from $19,500 in 2021. This increases to $26,000 if you're 50 or older, and take advantage of the allowed $6,500 catch-up contribution. Point 4. Variations of this type of account include the 403b, a similar retirement plan offered to educators, e.g. in public schools, clergy, and workers at 501c-3 tax-exempt organizations, and 457b plans, which are offered to state or local government employees. Individual retirement accounts, IRAs. An IRA is a tax-favored investment account. You can use the account to invest in stocks, bonds, mutual funds, ETFs, and other types of investments after you place money into it, and you make the investment decisions yourself, unless you want to hire someone else to do so for you. You might consider investing in a traditional IRA if your employer doesn't offer a retirement plan, or if you've maxed out your 401k contributions for the year. You can contribute up to $6,000 in 2022. This increases to $7,000 if you're age 50 or older. Point 5. This limit is unchanged from 2021 limits. You'll pay no taxes annually on investment gains, which helps them to grow more quickly. Many taxpayers can deduct their IRA contributions on their income tax returns if they don't also have a 401k retirement account, which reduces their taxable income for that year. Some restrictions exist based on income. Point 6. You pay income taxes on the money you contributed and on gains when the money is withdrawn in retirement. Point 7. You can buy and sell investments within the IRA, but if you try to take money out before you reach age 59 and a half, that is known as an early distribution, and you'll probably have to pay a 10% penalty fee, just as you would with a 401k. Point 8. You'll also be subject to federal and state and income taxes on the withdrawal. Roth IRAs. Unlike a traditional IRA, Roth IRA contributions are made with after-tax dollars, but any money generated within the Roth is never taxed again. You can withdraw contributions you've made to a Roth IRA before retirement age without penalty, provided 5 years have passed since your first contribution. You're not currently required to begin taking withdrawals at age 72, as you are with traditional IRAs, 401ks, and other retirement savings plans. Point 9. Putting money in a Roth is a great place to invest extra cash if you're just starting out and you think your income will grow. You can even contribute to both an IRA and a Roth IRA, but your total contributions to both plans can't exceed the $6,000 contribution limit for the year or $7,000 if you're age 50 or older. 5. Roth 401k. The Roth 401k combines features of the Roth IRA and a 401k. It's a type of account offered through employers, introduced in 2006. As with a Roth IRA, contributions come from your after-tax paycheck rather than your pre-tax salary. Contributions and earnings in a Roth are never taxed again if you remain in the plan for at least 5 years. The best part about a Roth 401k is that there is no income limit as with a Roth IRA. The annual contributions are the same as a traditional 401k, too, just with after-tax dollars. Withdrawals are the same as with a Roth IRA as well, but the distribution rules match those of a traditional 401k. 10. Simple IRA. The savings incentive match for employees. Simple IRA is a retirement plan that small businesses with up to 100 employees can offer. It works very much like a 401k. 11. Contributions are made with pre-tax paycheck withdrawals, and the money grows tax-deferred until retirement. Early distributions can result in a hefty penalty. However, unless you qualify for an exception, you'll have to pay an additional 10% tax on the amount you withdraw from your simple IRA, similar to traditional IRAs and 401k plans. If you make the withdrawal within 2 years from when you first participated in the simple IRA plan, this additional tax increases to 25%. 12. You can borrow from a simple IRA either the way you can from a 401k. SEP IRA. A simplified employee pension, SEP IRA, allows you to contribute a portion of your income to your own retirement account if you're self-employed and have no employees. You can fully deduct these contributions from your taxable income. The maximum annual contribution limits are higher than most other tax-favored retirement accounts, $61,000 for 2022, up from $58,000 in 2021, or 25% of income, whichever is less. Retirement savings plans. Save for retirement using tax-sheltered savings plans. Saving for retirement is a lifelong activity. Saving as much as you can over time pays off because it lowers the amount of tax you pay each year and allows you to accumulate more assets for your future retirement. There are a variety of tax-sheltered plans that will accumulate retirement savings. Each plan has its own unique set of rules for determining what is considered taxable income in retirement. Here is a list of the basic retirement plans that every taxpayer should understand. Individual retirement accounts. Any taxpayer with earned income from wages or self-employment can fund an IRA, individual retirement account. Your IRA contributions may be tax deductible. There are traditional, deductible IRAs, Roth IRAs, and non-deductible IRAs. Which one is best for you depends on your income, whether you are covered by a group retirement plan at work, and whether you prefer a tax deduction now or tax-free income in retirement. Deductible traditional IRAs. In 2021, you could save up to $19,500 in your 401k. This increased to $20,500 for 2022. 1. The limit for individual retirement accounts, IRAs, is currently $6,000. For tax years 2020 and later, there is no age limit on making regular contributions to traditional or Roth IRAs. Older savers, age 50 or older, contribution limits consist of a base contribution limit and a catch-up contribution limit. For example, in 2021 and 2022, the base contribution limit is $6,000. For IRAs, you can put in an additional $1,000. Therefore, a person who is 52 years old and otherwise qualified for a traditional IRA could contribute $7,000 total to his or her account. Contributions to a traditional IRA are tax-deferred, meaning that you will not pay income tax until you withdraw the money. 2. You can begin making withdrawals from your traditional IRA at the age of 59.5 without having to pay the early withdrawal penalty. All withdrawals are taxed, including past contributed principal, since it was tax-deductible at the time the contribution was made, by the age of 72 years old, so you cannot accumulate too much money in the tax shelter. 3. Non-deductible IRAs. If your income exceeds specific levels, you may not be able to make tax-deductible contributions to your regular IRA, or the amount of your contribution may be limited due to certain restrictions. Point 2. However, you still can save for your retirement with a non-deductible IRA contribution. Although your non-deductible IRA contributions won't reduce your taxes in the year you make them, you can tax defer the earnings on them. This is the key tax advantage of a regular IRA. Although you will not receive any immediate tax benefit from a non-deductible IRA contribution, the tax-deferred growth may ultimately make the contribution worthwhile, especially if you expect to have a lower tax rate after you retire than you do now. Point 4. Roth IRAs. Contributions to a Roth IRA are made with after-tax dollars and are not tax-deductible at the time they are made. However, unlike a traditional IRA and subject to certain minimal conditions, if you need to make a withdrawal of your past principal contributions, you can do so tax-free without an early withdrawal penalty, though you won't be able to replace the funds once they've left the account. There are tax consequences for any investment gains or other funds in excess of the historical contributions into the Roth IRA, if taken before the age of 59.5 years old. Point 5. During the years the money is in the Roth IRA, any profits you generate will grow tax-free, and there is no mandatory distribution age. Bankruptcy protections cover the traditional IRAs and Roth IRAs. Point 6. If you have income exceeding the limits for a regular IRA deduction, a Roth IRA might be preferable to a non-deductible IRA. Although neither contribution is deductible, with a regular IRA the contribution grows tax-deferred, but a Roth IRA contribution grows tax-free. 401k savings plans. A 401k plan is a workplace retirement account that's offered as an employee benefit. The account allows you to contribute a portion of your pre-tax paycheck to tax-deferred investments. Every dollar you contribute reduces your taxable wages, thereby lowering your taxes. For example, you would be taxed on $70,000 if you earned $75,000 and contributed $5,000 to your 401k. Investment gains grow tax-deferred until you withdraw the money in retirement. If you withdraw funds from the plan before age 59.5, however, you could pay a 10% penalty, and the withdrawal would be subject to federal and state income taxes. Point 75. Many employers match employee contributions to a 401k, typically up to 6%, although it might vest its contributions over a period of years. This means you would not be able to take your employer's contributions with you if you were to leave the company before the prescribed period of time has elapsed. Your own contributions to the plan are always yours. However, an employer match is effectively free money. Employers who offer these plans are often willing to let you make contributions through automatic payroll deductions, making saving easier. Investment choices for these types of plans are often limited, and management and administrative fees can be high. The IRS imposes contribution limits per year, although limits for 401k plans are more generous than those for other plans. $19,500 in 2021 and $20,500 for 2022. They increased to $26,000 in 2021, $27,000 in 2022, if you're age 50 or older. 7 smart ways to secure guaranteed retirement income. What's the easiest way to achieve guaranteed income? Buy it. This is exactly what you do. When you purchase an immediate annuity, you use a lump sum of money to purchase guaranteed income. You can choose an option where the income will pay out for your entire lifetime or for joint lifetimes if you're married. The purchase could be the deal of a lifetime for aspiring centenarians. There's no way you can outlive your income with an immediate annuity. As the name implies, immediate means the income starts right away, so the best time to look at this option is when you're ready to retire and you want an income that will begin immediately. Exactly how much monthly income you can receive depends on your age. The older you are, the higher the income you'll get per dollar that you invest. Use a withdrawal benefit rider on a deferred annuity. If you want to purchase guaranteed income at some point in the future, look for an annuity that has a guaranteed minimum withdrawal benefit rider, sometimes called a GMWB, or a lifetime withdrawal benefit, an LWB. With this type of investment, you deposit your funds today with the intention of taking out income at some point 10 years or more in the future. The annuity company takes a snapshot of your account value each year as you go along. As the account value grows, the new higher value is locked in as the new income base. You can use the larger of the current account value or the income base value to generate your guaranteed withdrawals when you activate your withdrawal rider. The amount you can withdraw typically varies from 4% to 6% of the account value income base value, with the exact percentage being dependent upon your age at the time of withdrawal and the terms of your contract. Using this option can be a good way to protect account values from the impact that a major market decline would have if you're 10 to 15 years away from retirement, particularly if it should happen as you get nearer to your retirement age. Work toward getting a pension. It's great to retire with a pension. Some professionals spend the last 10 years of their careers working at a government agency just so that they can get a pension. This is a smart move for those who didn't save enough toward retirement earlier in their careers. Look for employers that offer pensions and check to see what the vesting schedule is. And if you're thinking about changing employers, you might want to wait a bit longer if working the extra time means you'll get more guaranteed income. These choices can help make your retirement more secure. Some people worry that their pensions might not pay out all the benefits they were promised. The older you are when you start your pension, the more secure your income will be. There's a form of government insurance called the Pension Benefit Guaranty Corporation, or PBGC. It protects pension benefits, but the amount that's guaranteed has a cap. The insured amount is reduced for each year you retire before age 65. If your pension is covered by the PBGC, begin benefits at 65 or later to maximize the insured amount. Point 1. Get a reverse mortgage. Guaranteed income is just that. Income that's guaranteed for life with no risk on your part. A reverse mortgage can provide that level of security, and the income is tax-free. So why don't more people use them? 2 reasons. Fear and fees. First, people fear that the bank can take their home. This was true long ago, but regulations have changed dramatically in the last 30 years. This product is now safer, stronger, and less risky for the borrower. Second, some people think that the fees are too high. Once again, regulations have improved this situation, and fees today cannot exceed limits specified by the government. If you're age 62 or older, if you're looking for guaranteed income, and if you've paid off your home or have plenty of equity in it, a reverse mortgage might be a viable option. Point 2. Be careful about when you claim Social Security. Most retirees receive the largest portion of their guaranteed incomes from Social Security. Those receiving Social Security benefits get a cost of living adjustment each year, which usually results in an increase in benefits. The problem is that most people still take Social Security too early, or they don't coordinate with their spouses if they're married. Hundreds of thousands of dollars of income that would be paid out in the form of spousal benefits and widower benefits can be foregone because one spouse made an unwise decision about when to begin his benefits. Don't be foolish and rush to claim Social Security at 62. Starting benefits at a later age will often deliver a better outcome for you and more guaranteed income over your lifetime. Put money in a deferred income annuity, or QLAC. Longevity insurance is a form of a deferred immediate annuity that will guarantee you a minimum amount of income at a specific future age, such as 85 or 90. There's a special form of this product called a QLAC, or Qualified Longevity Annuity Contract, that's purchased inside an IRA or 401k. The QLAC allows you to defer the start of your required minimum distributions. People with longevity insurance feel more secure about spending their retirement money on fun and travel while they're younger, because they know they have a future source of guaranteed income to provide for them later. Build a bond ladder. Many retirees are afraid to spend principal, but it can be perfectly okay if it's structured the right way as part of a plan. You can build a bond or a CD ladder where you buy a CD or bond that will mature in a specific year and an amount you'll need at that time to cover expenses. When the bond matures, you spend it. Another option is to use Treasury securities, which are considered to be one of the safest investments you can own. They're bonds issued by the U.S. government. Financial institutions can strip the interest portion of the bond from the principal portion, creating something called Treasury strips. You can buy these strips with maturities that are laddered out, creating a guaranteed stream of income with each strip maturing in the year when you'll need it.